taxes. Income taxes is very important, and that's why we've done all these different parts. This part now deals with one of the most difficult elements of income tax, which is the deferred tax. Just to do a recap, we started with the framework of income taxes, and in that framework we actually pointed out that all income earned in a particular year is taxed, but not all tax is payable to ZIMRA in that year. That which is payable in the future, hence deferred tax, is calculated and separated differently, and you either recognize a deferred tax liability or deferred tax asset. Now this section and the next section, part 3.1 of it, we will be looking at deferred tax implications. Specific coverage for deferred tax will talk to what is deferred tax, exceptions to recognition, the tax base of an asset, tax base of a liability, and tax base of revenue in advance. We will also really get into the calculation of deferred tax and recognition of deferred tax in and outside the profit and loss. Let's quickly talk to what is deferred tax. So deferred tax is tax that is payable or recoverable in future periods as a result of past transactions. So the income has been earned in the current period due to transactions in the current period, but the tax will only be triggered in the future. It will be paid in the future. But according to accrual base of accounting, income transaction and events are supposed to be recorded in the period in which they occur. So the income occurred in this period, we are supposed to tax it in this to recognize the tax expense in this period, or to tax in this period. But the timing of payment of that tax will be in future, or ZIMRA will be paid in future. The other very important definition is carrying amount. Carrying amount is a calculation of the value of an asset or a liability at the end of a particular year, and carrying amounts are determined by particular specific standards for assets and liabilities. In taxation or for deferred tax point of view, carrying amount embodies or represents the future taxable benefits of an asset. Tax base. Tax base is measurement under tax law, and the tax base is the amount of the asset or liability that is deductible in the future. Temporary differences are there for the difference between the carrying amount and tax base at a specific date. Now, to get into detail, before we get into much detail, we want to quickly talk to the times or areas when we do not recognize deferred tax, and we want to put that away. So what we call exceptions from recognition of deferred tax on certain temporary differences. So a very important paragraph is paragraph 15 of IAS 12, which says deferred tax liability shall be recognized for all temporary differences, except to the extent that the deferred tax liability arises from initial recognition of goodwill. So ladies and gentlemen, the goodwill amount after calculation and recognized as an asset in the balance sheet or in the same financial position do not trigger deferred tax because of that exception on paragraph 15A. Also, there are certain times when we don't recognize deferred tax asset even though it's not goodwill. So let's take an example. At initial recognition of an asset or a liability, so you bought your building, you bought your piece of land, you recognized for the first time, which is initial recognition. If the transaction is not a business combination transaction, and at the time of initial recognition, it does not affect accounting profit or taxable profit, you shall not. So when I buy my car when I buy a building, at the date of recognition of that building, debit building, credit bank. First of all, the acquisition of that building is not a business combination. Second, at that point, there is not yet impact in the P&L, no depreciation as yet, nor any tax allowance that's allowed in the taxable income. So at that point in time, on initial recognition, that transaction would not cause deferred tax. On the contrary, if you look at the deferred tax asset, the deferred tax asset shall be recognized for all deductible temporal difference to the extent that it is probable that taxable profit will be available, against which the deductible temporal difference can be utilized, unless the deferred tax asset arises from the initial recognition of an asset or liability. So in other words, we should recognize deferred tax. And this will be very important when we look at assessed losses. The fact that we should recognize deferred tax to the extent that it is probable that taxable profit will be available to deduct. And that mostly refers to tax credits or assessed tax losses. However, if you look at your liabilities, when you recognize your liability, you got a loan, you recognize a provision on day one, if it's not a business combination, and at that point in time on initial recognition, it's not impacting P&L or the taxable profit, there shall not be deferred tax. So generally, at initial recognition of a transaction, there is no deferred tax asset or liability. In other words, deferred tax then will start to appear post the initial date of recognition. So what is deferred tax liability? It is the amount of income taxes payable in future periods in respect of temporal differences. So not looking at the liability only. When you look at the deferred tax asset, it is the amount of income taxes recoverable in future periods in respect of deductible temporal differences, which is, and also the carrying forward of unused tax losses and unused tax credits. So we'll really get into depth. Part 3.1 will talk into unused tax credits and tax losses separately. How do we calculate deferred tax? So the deferred tax function. You need carrying amount of all the assets. You need the tax basis. The difference is what we call the temporary difference. You then multiply by a rate to get your either deferred tax asset or deferred tax liability. And on this function, you do that for all the assets for prior year and for all the assets for current year. When you then compare prior year to current year, you get the total movement in deferred tax. That movement refers to the assets and liability that has been recognized in the current year, or the impact in the profit and loss, the impact in the current year. That needs to be analyzed. That movement needs to be analyzed to that which moved or which happened in the other comprehensive income, same in change in equity, and that which moved because of business combination, which affected goodwill, and eventually in the profit and loss account. So carrying amount is determined by IFRS or specific standards, whereas tax base is determined by tax law, as we learned, and temporary difference is simply the difference between the carrying amount and the tax base. Deferred tax liability or asset is the temporary difference times the tax rate there. The temporary differences, as pointed out, the difference between the carrying amount and tax base, that's where the heart of deferred tax is. And one mostly has to learn to calculate tax bases of assets, liabilities, and income received in advance. Whereas the carrying amount are determined in the particular standards where those assets are accounted for. So let's start with the tax base of an asset. Very critical. Under paragraph 7, the tax base of an asset in simple form is the amount deductible for tax purposes for tax purposes in future. So if I look at my asset, the cost of my asset, at a balance sheet date or a reporting date, how much of it will be allowed as a deduction in future? So let's quickly go to example 1. An entity buys PPE and of 100,000. It has a useful life of 10 years and it's allowed a tax allowance or wear and tear of 25%. So at the end of year 1, if you depreciate that 100,000, you get with 100,000 with 10 years, you get a carrying amount. That's what you normally do from an accounting point of view. You take away depreciation of 10,000, you get a carrying amount at the end of the year of 90,000. But for tax purposes, according to tax law, what is the depreciation for tax purposes? The depreciation is 25%. Now, the tax base of an asset is the amount deductible for tax purposes in future. Meaning, the total 100,000 was there at initial recognition. But at the end of the year, after removing 25%, 75% is still available to be deducted in future. So that 75% represents the amount deductible for tax purposes in future. That is the tax base. The difference between the two, therefore, is a temporary difference. If you take a receivable, very critical, do we have any deductibles on the receivable? So a receivable, 56,000 as an example, is taxed through revenue. Revenue income from trade has already been taxed. A receivable is a carrying amount of, is tax based. How much of it will be deductible for tax purposes in future? There is no deductions allowed on receivables because they've already been taxed at the earlier of receipt of accrual now. So nothing will be taxable in future. In that case, you should equate your tax base to the carrying amount so that there is no temporary differences. If you allow a difference that causes temporary differences, you are supposed to recognize deferred tax. Where there should not be a tax base, it's either better to equate or to refer that it's not allowed. Example 3 refers to dividends receivable. A company recognizes a debit account dividends receivable in the same financial position of 40,000 receivable from a listed investment. Local dividends are not taxable. So when I receive my dividend receivable, it's a receivable, it's an asset. I put that down as a carrying amount, but it's tax based. There is no deductibility. It's not allowed to be deducted. It's all actually exempt. So in that case, we either equate or just write exempt. So let's go back again. The tax base of an asset is the amount that is allowed to be deductible for tax purposes in future from a specific reporting period. So if you take as an example, an entity pays a 10,000 advance for utility, which is a prepayment. So the carrying amount is 10,000. How much of that prepayment is allowed? If this prepayment has been already deducted, meaning it's been allowed as a deduction in the current year, then there's nothing to deduct in the future. Hence, but if Zimbra has allowed it, has not allowed it as a deduction to match it to the future period, especially according to the adjustment or the 2017, 2018, some of expenses would be only deducted in the period in which they are incurred, then in that case, that amount which will only be deducted in future will be put as a tax base. So, understanding the tax base and being able to apply it is very critical. The next one is the tax base of a liability. The tax base of a liability being its carrying amount less amount deductible for tax purposes in future. Let's come again. The carrying amount less the amount deductible for tax purposes in future. Also very critical. If we go to example 5 to 6 of the in our module, right? So under example 5 and 6, we are saying we have a company that recognizes items at reporting date and has got water and electricity accrual, which is amount outstanding, and leave pay provisions. First of all these are liabilities, so they've got carrying amounts. But what is the tax base of water and electricity accrual? So it is the carrying amount of 5,000. How much of that 5,000 will be deducted in future? A lot of times, because this is expenditure in production or in trade, it may already have been allowed by the Income Tax Act as a deduction. So there won't be anything to deduct in future. Hence, the whole amount would be allowed to be deducted would actually have been deducted already. So the carrying amount less the amount that's not deductible. And in this case, because it's already been taxed, nothing will be deducted in future. In that case, the tax base therefore is 5,000 minus 0, which gives us a tax base of 5,000. Okay, if I can repeat again, our water and electricity normally for a business is already income in trade. And such income, so it's expenses in trades, and such expenses are allowed to be deducted in the current year even though you're not yet actually paid. So when we do our calculation of tax base, it's carrying an amount of 5,000. All of it has already been deducted even though not paid, which means 5,000 minus 0, which will be done in future, which means 5,000 remains as the tax base. Hence a temporary difference of 0. But for leave pay provisions will only or normally are only deducted when actually paid and or when leave is taken. So in other words, the carrying amount of 12,000 minus that amount or the whole amount 12,000, which will be paid in future when the leave is taken or when actually paid. Hence a temporary difference of 12. So in other words, water and electricity would not attract deferred tax, while leave pay provisions would attract deferred tax. One interesting item that has got very special deferred tax implications is the revenue received in advance. It is very important to note that revenue in advance could actually cause an entity to pay tax twice. If we remember very well under current tax, we said the income tax or ZIMRA would tax an entity when it receives income or when it is accrued. So for revenues in advance, the income has already been received, but services have not yet been rendered. So we need to create a deferred tax asset that shields that income in the future when it's now being included in the profit and loss for being taxed twice. So revenues in advance, the tax base of revenues in advance is equal to the carrying amount less that amount that will not be taxable in future. Less that amount that will not be taxable in future. So if you look at example 6, we are saying, okay, let's look at example 7. Okay, in this case, example 7 refers to a company receives 100,000 regarding service to be rendered to a client in the next accounting period, and recognize the liability to deliver services of the whole amount in future. So ZIMRA takes the income on receipt. So in other words, revenues in advance, in this case, the income has been received. It is a liability because we still have an obligation to deliver the goods or the services. So to calculate the tax base, we are saying the carrying amount, which is 100,000, minus the amount that will not be taxable in future, which means the whole 100 is not taxable in future because it's already been taxed at earlier of receipt or accrual. Hence, 100 minus 100, we get a tax base of 0, and eventually a temporary difference of 100,000. So, ladies and gentlemen, we realize that in the calculation of deferred tax, we either have got taxable temporary differences, which gives us a deferred tax liability, we have a deductible temporary difference that gives us deferred tax assets. Normally, assets, if your carrying amount is greater than your tax base, you get your deferred tax liability. Or if your carrying amount is of a liability is less than the tax base, we also get a deferred tax asset. On the contrary, normally our deferred tax assets come from liabilities, where the carrying amount of the liability is greater than the tax base of a liability. Where an asset's carrying amount is less than the tax base, also we can also have deferred tax assets. So we've actually walked through example 1 to 7. Example 6 was apparently looking at revenue received, the debtors, and allowance for credit losses. Okay, so the debtors, as we said, they don't attract deferred tax, but the allowance for credit losses are very special. Allowance for credit losses, ZIMRA normally gives a deduction for actual bad debts written off, which are verifiable. Whereas allowance for credit losses are potential bad debts. So when I've got a carrying amount of 12,000 for the allowance for credit losses under example 6, the 12,000 represents future possible bad debts. So when I do my tax base of allowance for credit loss, first of all, allowance for credit loss are negative assets, or they can look at them as provision for doubtful debts, which is like a liability. So its tax base is the carrying amount less amount deductible in future. The carrying amount being 12. The whole 12 will be deducted if it becomes a bad debt. Hence, the temporary difference of 12,000. This section, example 1 to 7, are very critical examples to play with, which also includes example 9 and 10 for exceptions. Now let's talk about recognition of deferred tax. Deferred tax is recognized in and outside the profit and loss. So current tax and deferred tax shall be recognized outside profit and loss if the tax relates to items that are recognized outside. And where exactly outside, it can be recognized in other comprehensive income, or directly in equity, or in goodwill. So generally, deferred tax is recognized in OCI, in equity, or in goodwill, but the bulk of it is in the profit and loss account. Let's quickly go one by one. When you look at the recognition of deferred tax in the other comprehensive income, you have to go to the other comprehensive income, or to go to S1 and look at items that are recognized in other comprehensive income. And this is an example. So if you put a revaluation gain in the profit and loss in the OCI, you also put the tax expense as illustrated here in the OCI. If you put a cash flow hedge reserve or exchange differences, you also put the tax where the income has gone. Recognition of deferred tax in equity. Just a few things goes into equity. So specifically, if you have restated the opening retained earnings, either due to a prior period error or a change in accounting policy, that restatement, the deferred tax implications also go directly in the opening retained earnings and adjust the equity, the signatures in equity. Where we have got a compound financial instrument, the equity component under paragraph 23 also requires, so there is an example that illustrates the compound. Example 11 illustrates how a compound instrument in paragraph 23 works and the equity in the equity component. But for prior period errors and change in accounting policy, that should be done under IAS 8. Recognition of deferred tax due to business combination. Let me emphasize that the recognition we are talking about here for business combination is what is happening at acquisition date. In other words, this deferred tax affects goodwill. So, under paragraph 16, paragraph 19, 26, 66, we are told that an acquired entity, which is a acquiree or subsidiary, may have its own carrying amount. But under business combination, assets and liabilities are recognized at fair value. The difference between the fair value at acquisition debt and the carrying amount of an asset could actually increase our deferred tax, especially for business combination accounting purposes, and that affects goodwill. Therefore, that difference due to fair value, if it is, goes to goodwill, affects deferred tax. However, the goodwill figure itself does not affect deferred tax, or does not recognize, we don't have deferred tax on it. As pointed out before, that amount is exempted under paragraph 15A of IAS 12. Now, ladies and gentlemen, if we are in agreement that our deferred tax arises in the P&L, in the other comprehensive income, in equity, and sometimes through goodwill at the acquisition debt or business combination. Therefore, we should have to be able to have a reconciliation. If I take my opening balance, I should be able to reconcile with my closing balance by showing the movements as that which went through P&L, OCI, equity, and goodwill to come to my closing. This, as you will see under our disclosures, is part of a disclosure required for the deferred tax balance. It's called the deferred tax reconciliation. Now, we are coming back again to the proper calculation of deferred tax. So deferred tax normally therefore arises from temporary differences. We learned, under current tax, we learned what we call permanent differences. These are differences that will never reverse or agree. So in other words, the taxman and the accounting treatment will never agree. But where there's temporary difference, they will eventually agree. So, as we learned then, the carrying amount is determined by IFRS, the tax base is determined by tax law, and the temporary difference is the carrying amount less the tax base, and the deferred tax is the tax rate, the tax temporary difference times the future tax rate, and I want to emphasize future tax rate. We'll talk about that on measurement. Now, we also learned that when we calculate our total movement in temporary differences, which is closing temporary differences of current year less opening temporary differences, we get the total movement. We need to be able to analyze that which went through OCI, stolen shares and equity, IFRS 3 goodwill, and that which is left in the profit and loss account. Now, under current tax, we also learned that when we take our profit before tax, we remove permanent differences, which is the non-taxable income and non-deductible expenses. We arrive at total accrued income. But before we calculate current tax, we have to say how much of the temporary differences are deferred in the future, which affects P&L. In other words, how much of this income will not be taxable now or be taxable in the future. And that calculation comes from the previous slide where we showed the movement in temporary difference that goes through P&L. If you deduct that, you then left with the current tax, which is supposed to be deductible now. Therefore, there is a relationship between deferred tax and current tax, which says if deferred tax increases, it means that we are deferring more taxes into the future. In other words, current tax has to decrease. If deferred tax decreases, it means that we are reducing what we are deferring in the future. In other words, current tax increases. This is a very fundamental element that needs to be picked and be learned and be practiced. Ladies and gentlemen, if we then put things together, we then can see how the tax expense in the P&L has current tax and deferred tax. The current tax is derived using the taxable income times the tax rate. The deferred tax is the movement between the closing and opening deferred tax balance through the P&L. That analysis at the bottom of the calculation of deferred tax is very, very critical. Right. So let's go quickly to example 21. So if you go to example 21, it picks up this principle very well. So example 21 has got a profit of 400,000. The entity has got exclaimed as a profit of 21. It has no permanent differences. So all of a sudden, we've got all income being total accrued, but it acquired a plant of 400,000 on 1 January 2023, which is a 5-year useful life. That's for accounting purposes. But ZIMRA allows 25% special deduction allowance and 25% accelerated for the last 3 years. The same entity also has got prepayment of expenses, 20x3 and 20x4, 6,000 and 8,000 respectively. It also has got revenue received in advance of 12,000. The plant was revalued for 22,000 at the beginning of 20x4. So what we see in this example under example 21, we see profit before tax, which affects our current tax. We see information for temporary differences. We saw assets, the plant, the prepaid expenses, but we also saw revenue received in advance as well, right? So one thing we need to learn is to say, if we take our profit before tax, we need to tax all of it. So if you take 400 times 25%, 5%, you get 103,000. But the question is the 400 income that we made all taxable in the current period? So what we do is we first go and calculate our deferred tax and look for movements in temporal difference through P&L. So if you got your working 2 on deferred tax, you've got current year and prior year. Under prior year, we had planned. Its carrying amount was 320, prepayment 6,000. We had our temporary differences there of 26,000. If we apply the same to that plant this year and prepayment and whatever, we also then also see our profit before tax, our temporary differences of 52,500. Now the movement between the two temporary differences gives us 26,500. But at the beginning of the year, the plant was revalued for 22,500. So if you take away 22,500, because revaluation is recognized in P&L, you then see that the movement in temporary difference through P&L, the revaluation is in OCI. Directly, revaluation is in OCI. You see 4.5 recognized in P&L as far as temporary differences are concerned. In other words, when we look at our 400,000, not all of it will be taxable now, because 4.5 should be deferred and taxable in the future. Why do we say that? Because our prior year temporary differences and our current year temporary differences, the temporary difference has increased, meaning that we are deferring more taxes. So on the calculation under working 1 of calculating current tax, we take our 400, we take away permanent differences. When you come to plus or minus movement in temporary differences, we are deducting, because as the deferred tax increases, current tax has to decrease, or otherwise we are saying 400,000 is not all taxable now. 4.5 of it will be taxable in future. So only 395 will be taxable now. Hence our current tax under example 1 is 101,841. However, the 4.5 gives us deferred tax of 1159. So coming back again to accrual, if you go to your tax expense on page, or on example, on a tax expense, you see that the current tax is 101, which means most of the income has been taxable now. whereas the deferred tax is 1159. Why are all of these part of the tax expenses? Because all the income has been made in the current year. So the tax expense should be accrued for all the income that has been recognized in the current year. However, the timing of payment is different in the case that the payment for current tax will be right now in the current period. However, the payment for deferred tax will be sometime in the future. The example, the last journal entry, the combined journal entry, also shows it in a better way to say tax expense of 103, which is made of deferred tax 1159 and a current tax to ZIMRA 101841. The measurement of deferred tax, ladies and gentlemen, is very critical as well. Deferred tax does not necessarily have to be measured at the current tax rate. Deferred tax is measured at using the expected tax rate that are expected to apply. So as an example, in November, and the budget is announced, a tax rate is already been told or changes in allowances and deductions or requirements. So the deferred tax rate for 2018, as an example, is based on the tax rate announced, because we are saying in 2018 the budget of 2017 has already announced the budget of 2017. When I'm calculating my 2017 deferred tax rate, I would use, so I'm calculating my deferred tax rate for 2018, I use the 2017 announced rates. When I'm calculating my 2019, I use the 2018 announced rate. But at the same time, for 2018, if the tax rate changes, I would use the new rate that has been announced before the reporting date, because that's what I expect to use in future. The measurement of deferred tax, if there is a deferred tax rate change, it needs to quickly be adjusted on the opening balance, especially if you look at the example that's being given here. The deferred tax liability of 250 from a temporary difference of 1,000 if you use a 25% rate. If a tax rate has been changed to 30%, we go back to 1,000 temporary differences, we calculate our 30%, which is 300. We adjust, in other words, deferred tax has increased, deferred tax liability. In other words, we credit deferred tax liability with 50 and our tax expense in the year in which the change happened. Example 19, the module, deals with deferred tax calculation, deferred tax rate change solidly or comprehensively. Expected manner of recovery. We only don't calculate using the expected tax rate, but it also should be the tax rate that is congruent in the manner in which an asset is recovered. An asset is recovered through use, sale, or both. So as an example, if an asset is recovered through use, then we should use normal tax rate. And normally it has no residual value and it is not classified as held for sale. If an asset is classified as held for sale, it is covered through sale. If an asset has a residual value, it means that it will be used and then sold. Assets sometimes may be carried at fair value, e.g. investment properties, shares, and their recovery will result in taxable economic benefits to the entity, and the amount that will be deductible for tax purposes would differ from the amount of those economic benefits. So as an example, if an asset is carried at fair value, the entity does not intend to dispose the asset. In such case, the required carrying amount would be recovered through use. Where we want to sell and the value, the fair value is above the cost, then it triggers capital gains tax. So we also need, which means an asset can be charged two different rates. So if the element that is under normal tax, which is like recoupment, we use the normal tax rate. The element that shows capital gains tax, you use the capital gains tax rate. So for investment property, as an example, under paragraph 51C, it talks that investment property are held at fair value and you are not expected to use them up. So in other words, investment property should be charged using the capital gains tax rate to the extent that it affects capital gains. But if the investment property is getting wear and tear, that portion would actually attract no more tax. Then if you look at paragraph 51B, which looks at non-deductible, non-depreciable assets, right? So this deals with the case of non-depreciable assets like land and buildings or revalued assets. Or in that case, we have to assume that the only way the asset is going to be recovered is through sale. And in that case, we apply a capital gains rate. So we use the CGT rate, e.g. land. So land may not be investment property, but its manner of recovery can only be through sale. It can't be used up. Ladies and gentlemen, if there's any questions, or you can bring them to class or take them to a tutor.